Tibrewal of Kotak Mahindra AMC. Let's now invite the management of DLF, Ashok Tyagi, the whole-time director. DLF is now joining us on the show now in our corporate corner. Mr. Tyagi, morning. This is Rima here. You know, the last time we spoke to you, you were so bullish about luxury demand. Every time you would launch it on day 1, day 2, day 3, you would see blockbuster sales and pretty much sold out. How have things been in, the festive season as well as in the first half of Q3, October as well as November? Any numbers that you could share which gives us an indication of demand?
Okay, so good morning, Rima. Clearly, while I would hesitate to share numbers, frankly, because of all the disclosure norms, but I can assure you that the luxury demand continues to be unabated. In fact, just at the fag end of Q2, I think maybe 28th or 27th of September, we had launched a project called Grove in DLF 5 on the golf links, which are luxury independent floors, priced between 6 crores to 10 crores. And, in the first fortnight of October, I mean, virtually all of them have sold out, So I think the pace of absorption of good luxury, and by good luxury, I mean luxury which is well located by credible developers, I think that continues. Obviously, with the interest rate hikes, one always needs to be extremely cautious. But so far, I think the pace of demand absorption continues to be very strong. And not only on luxury, even in the other mid and the more premier segments as well.
Based on the pipeline, do you think you can sustain quarterly bookings above 2,000? You have for the last 4 quarters. At least if you could tell us, can your bookings be above 2,000 on a quarterly basis from here on?
Yes, I mean, we have guided the market to an annual sales target of 8,000 crores plus. And frankly, given the first 2 quarters, given the performance so far in Q3 and the pipeline for Q4, I think we are definitely very confident of hopefully breaching that.
All right. Hi, Mr. Tyagi. Good morning. And, you're sounding a little bit cautious, but your undertone is more bullish, I think so. So this interest rate hikes that we have been talking about, as of now, at least, no big impact. But though, you need to be a little bit cautious in case we do see more of the same. What about pricing? Have you pushed through a couple of price increases? Some of those input costs have started cooling off. Did you do all the price hikes earlier? Or have you stalled on that?
So Nigel, the price hikes, not that we were hiking prices for the sort of, heck of it, but clearly we had followed a responsible price trajectory in the sense that we have increased prices, to cover the input costs, as you rightly said, which you are right, has begun sort of plateauing now, though it's plateauing at a higher level than what we would have liked it to be. And the second thing is clearly that, the price hikes in terms of, the next launches or the next edition of the launches of our products continue to be at price levels that were higher than the previous ones. And so far, the market seems to be absorbing them, pretty neatly, We have not faced a price-linked resistance so far, but obviously, given the entire macros, one does need to be cautious. You can't be reckless in pricing. The trajectory should still hopefully be positive, but you can't be reckless in pricing for sure.
All right, Mr. Tyagi, hi, good morning. Just to go back to that interest rate question, at what, there is presumably another 50-60 basis points more to go from where we can see, how far out we can see in terms of rates going up, policy rates, etc., and that will reflect in what banks offer to customers. At what point does it start to hurt your set of customers, you think?
So, Prashant, historically, if you see, interest rates of ballpark 850, by interest, I mean mortgage interest rates. 850 people were comfortable paying. It was once they started approaching the 9s that, it did start having a bearing on the demand. We began this cycle with interest rates at a historical low of 6.5, 6.6. They, I think, now in the 8 quarters to 8 halves. So my view, frankly, Prashant, is the next 50 basis points hike, the market should hopefully absorb. But, if because of any force majeure conditions or anything crazy going out there in the world, it sort of crosses 9 on a very sustained basis, then I think it could have a bearing. But again, the past is not always a guide to the future. But we believe that the market has done well to sustain the last 2 percentage basis points hike. Maybe it can sustain the next 50 odd basis points. But if it's if it's a sustained curve still, then obviously everybody will need to be slightly more cautious. Hopefully, by whatever one reads of all the pink newspapers, we are in the last 50, 60 basis points of the interest rate hike. So hopefully, we have weathered this storm, but let's see how it pans out. But 850, 875, I think the market has demonstrated that the consumers can absorb that.
Yeah, it can absorb. But 9, closer to 9, above 9, maybe we'll have to see.
Yeah.
But as you said, past performance is not an exact guide to what happens in the future, but we can take some kind of lessons from that. What about office leasing, Mr. Tyagi? How will that hold up? Again, using history as a guide, because there is this US recession. We're already seeing, freezes as far as new hiring is concerned. General cost cutting, right, in the US from the top companies, IT companies as well. So how is that likely to impact you?
So the office leasing has been a complex market. The fact is that our office vacancy levels, which used to be historically 4 to 5%, had shot up to 15-16% in the midst of COVID. The good news is that they're inching back to normalcy. I think today now we are back to an occupancy level of 90% plus. That means the vacancy levels of just under 10%, and hopefully that direction continues. People are back to signing reasonably big leases. The change is that we are observing, at least in our premium office spaces, is that a large part of the spaces are being leased by captives of the BFSI and the foreign corporates. The third-party IT industry, you're right, may have some bearing on all that's happening, but I mean, a large part of the global captives continue to look at India as a very strong destination. In fact, if you will, during COVID, India has sort of demonstrated even further its utility and reliability, to the global business chain, in terms of how we continue to provide the services as a country and as an industry. We are seeing the office leasing coming back to normalcy. We have 2 new buildings in Gurgaon called Downtowns, and both of them have been completely pre-leased. We have launched the 3rd tower. We are in the midst of putting up a 2.5 million square feet office complex in Chennai, which also is about, I think, at least half of it is pre-leased. During the midst of the COVID, as we had reported earlier, we signed one of the biggest, captive leases for a multinational bank, which actually is their biggest back office globally. So I think you're right that work from home, recession, some of these things could have a bearing. But I think we are definitely back from the troughs of the 2020s and early 21s. And I think the leasing momentum is gaining all over again. On the offices side, retail, of course, has been a completely different story, because retail has been a completely V-shaped recovery. And, frankly, I mean, retail in most segments today is actually doing better than even pre-pandemic.
It's more like a K-shaped, sir, but you are placed at the right side of the K on the retail side, where we are seeing that recovery. Just a quick update. There was an auction notice issued by lenders for the Ambience Mall in Delhi, and you had previously indicated that you're open to exploring whether you want to go ahead and acquire Ambience Mall. We don't have any update on that, so if you could help us provide any auction dates, have you done some due diligence?
To the best of our knowledge, while the auction notice had been issued, I don't think there's been any downstream steps that have been taken by the lenders, at least not that we are aware of, frankly. I mean, it's a well-located mall from our standpoint, but frankly, these are very hypothetical questions till such time that there's actually a trade in the market, which I think, as we speak right now, doesn't seem to be there.
There's no movement on that front then, Mr. Tyagi.
Yeah.
Okay. What about Ashoka Hotel? You told us in the past it's not going to be an ego issue for you, but any progress there? Have you changed your mind?
No. I mean, 2 days or 3 days back only they have come up with the initial reserve price.
Is it?
So I mean,
that reserve price is looking too high?
I mean, it's 7,400 crores. So it's almost like just short of $1 billion. So anyway, I think the good news is that we have enough land banks of ours in NCR and in some of the other geographies where we want to play. So we don't need to be buying land to support our growth momentum. We have enough growth. We have enough land parcels to sustain our growth momentum, both in the offices and the retail malls and the residential, developments. I mean, if there's something truly nice and strategic at hopefully an opportunistic pricing, one should look at that. But clearly, we don't need to be buying land for the sake of growth.
All right, Mr. Tyagi, we'll leave it there. Thank you very much. Great speaking with you. It's always a good conversation, sir, understanding what's happening in the real estate space and DLF.